Welcome everybody to the latest in the series of NCP Digital Family Offices webcasts. Today, our topic is farmland and regenerative farming. As a family office, we always look for non-correlated and alternative assets to complement our publicly traded securities. And one of these is farmland. Joining me today is Duncan Vink of Signature Asset Management, a division of the South African insurance company Old Mutual, and Andy Ross of the Sovereign Infrastructure Group based in Chicago. Just before we do get started, though, I'd like to give a quick disclaimer that what we talk about today is for education and maybe even entertainment purposes. It is not to be construed as investment advice. We don't know your personal circumstances or what your portfolio is, so we're in no position to give you investment advice. So please don't take it as such. With that, I would like to ask Andy and Duncan. We'll start with Andy. Just give us a quick elevator pitch on yourself, and then Duncan.
Sure, that's great. Great to be with you, Russ. Again, my name is Andy Ross. I'm with the Sovereign Infrastructure Group, and we are a global financing company that works on financing infrastructure projects and is involved in asset management both internationally and in the U.S. And we are partners with Duncan and his firm on a global ag tech regenerative agricultural fund.
Great, thank you. And Duncan.
Yeah, thanks, Russ, for the introduction and for having us on the podcast. My name is Duncan. I'm one of the founding partners of Signature. We're based out of the Netherlands, but we are active in the wider region. Originally, we started off in investing in agriculture on the African continent. On behalf of a number of institutional clients, we invest in agricultural and farmland assets across the continent, ranging from investments in Morocco, Nigeria, Malawi, Zambia, and increasingly we're looking to expand our footprint and our capabilities into the Southern European and North American farmland context.
And maybe to kick our conversation off, talk a little bit about farming and farmland as an asset class and how it actually fits into a portfolio. What attributes it would have if it was put into maybe a more traditional 60-40 portfolio.
So farmland historically is a very old asset class. In fact, in that sense, a lot older than stocks, which were only traded as of the 17th century. Fixed income around about that time. I think the first government debt was issued by the English government somewhere in the 18th century, while farmland investments are actually dating way before that. So historically, in all ancient civilizations, the wealthy ruling class had their wealth stored in farmland, in real estate as such. So in that sense, it might sound like a more exotic asset class. In a way, it's actually much older and much more traditional than stuff that we invented later on. Be it as it may, you see institutional investors coming into this space in the US like 30, 40 years ago. As you look here in the Netherlands, you've got insurance companies who have been invested in farms by the turn of the 20th century, around about 1890. So in a portfolio, it can serve a purpose of, like there's an introduction as well as any other alternatives, non-correlated. It goes to different growth and growth cycles as other asset classes. In that sense, it gives a diversification benefit, your textbook advantage of increasing in portfolios, your risk return profile. It's also positively linked to inflation, while other asset classes are often negatively related to inflation. So in that sense, it provides a genuine inflation hedge because, as we all are experiencing currently, we see food price inflation across the globe due to different factors coming to the fore at the last couple of months. And that's what we also see in our portfolios, is that will in fact impact our performance positively as we see crop prices rising, and over time that should reflect itself in increased values of farmland assets and agricultural assets in general.
Mm-hmm. As an institutional investor, when you're looking at farmland, um, the return profile, what attracts you more? Is it the potential for capital gains in the value of the operation and the farm, or are you really looking more for an income stream from the properties that and the farms that you own?
Yeah, it's a combination. The nice thing is that farmland assets in Africa are still reasonably priced, although you also see increasing values there coming through as well. So, but your direct yields and your direct returns on farmland assets are still substantial and also substantially higher than returns in developed markets like, for example, North America or developed parts of Europe. So in that sense, you can still have a combination of both, of direct yield as well as indirect returns through capital gains.
Now, your focus, certainly with the fund that you're building now, but I think overall has been a concept known as regenerative farming. And I'll throw it to you, Andy, if you want to explain what that is. It looks to, from my readings and my understanding and my background in agriculture, it seems to be the way that farms should go. Sort of flies in the face of, to a certain degree, of agribiz, but perhaps Andy, just give us a bit more explanation on the concept and why it's of interest to you guys.
Sure. So, I mean, basically, it goes down to a very simple concept: is that our two greatest resources are water and soil. And basically, by using practices that do not prevent our soil from being enhanced and basically degrading our soil through traditional farming practices, that's going to mean that we're going to be able to grow less and less food for a growing population. And so basically regenerative agriculture is about enhancing our soil, protecting our soil, and ensuring that that we're going to be able to meet the food needs for our dramatic, growing globe. And I will turn it over to Duncan to get a little bit more in the weeds about what this specifically entails, but involves stuff like reforestation, planting more trees, and a variety of other practices to ensure that we're doing the most that we could do to enhance the yield while also not decimating our soil. So why don't I turn it over to Duncan to get a little bit more details?
Thanks, Andy. I think it's a good introduction. So it's a bit of a bucket kind of, how do you call it, a word around it. So it's actually encompasses a lot of different methodologies, but the basic premise behind it is that it has a holistical kind of view on farming. And as Andy already alluded to, it's opposing the extraction of the natural resources. It's like a continuous improvement of your farm and its environment, which enhances the value and the productive capability of your farm by utilizing long-standing sustainable farming methodology where you upkeep the productive capacity of your farm. And you can do that through different means. So it has to do with less tilling of soil, or eventually zero tilling, providing organic matter back into the soil, utilizing as little pesticides and inorganic fertilizer as possible, investing into the surroundings of your farm in order to get your natural pollination around the water table management, anti-erosion. So it's a whole complex of measures which creates a regenerative agricultural environment and farm. So that's also something else than organic farming per se. It goes wider, where organic farming purely focuses on how do you actually grow your produce and not utilizing any kind of pesticides or inorganic fertilizer as such. This actually goes wider in the sense that you take into account your complete environment and your position as your farm in the total context around you. So that also includes involvement of social factors around you, which is particularly relevant in an African context, is where we work, and biodiversity measurements in your ecology, which actually goes further than traditional organic matter. So they kind of overlap between the two, but there are also certain differences between them.
When I look at it from a business point of view and return, there are I can see the long-term benefit of soil and water being able to maintain their capacity, but for some investors that are looking more quarter to quarter, year to year, does it increase your input costs? Does it reduce yields? Or is there more labor or more inputs required in regenerative farming, or is it pretty much a wash with what we would consider in today's context more traditional methods?
Yeah, I think increasingly you see regenerative methodologies being applied across the board and becoming more and more mainstream. In that sense, if you look at the organic spectrum of the things where you're utilizing less input costs like pesticides and stuff, you're actually lowering your input cost, but then also that your yield goes down, particularly in the early stages. But with regenerative measures, you should be able to reach similar type of yields during your first period. But on the other hand, it also, while traditionally farming might look at maximizing yields within the next year or the next 2 to 3 years, regenerative agriculture looks at the very long term and maximizing yields over a very long term, which eventually should also reflect itself in an enhanced value, because your productive capacity of your natural resource, i.e. being the land and the water, actually are being able to sustain you on a much longer time and that should reflect itself also in valuations of the assets which are under management.
Which is really interesting, because looking at it from a family office point of view, we think in multi-generational terms. So it actually lends itself to be attractive just because of that, because it is an asset class that we can hopefully rely on for generations as opposed to the next couple of quarters. Andy, I think you had a comment there.
Oh, no. I know. I totally agree. I mean, it's what's the old phrase? What's the definition of insanity? Doing the same thing over and over again and expect, a different result.
Yeah.
And just again, Duncan has way more agricultural expertise than me, and obviously Russ, you're a former farmer, so I'm kind of boxed out here, but I know that just again getting back to what I said earlier, our two most precious resources are our soil and our water. And we have to engage in practices that will maximize the benefit of this precious resource, meaning our soil, coupling it with the water in a way that will deliver us the food that we need to feed, the growing planet. So, this is like, and what's so interesting too, Russ, is that we were talking about this a little earlier, is that you can't get a better example of what's going on in the planet right now than just this summer. Europe is literally imploding in terms of the heat waves. Southern Europe, Africa, the U.S. The climate is changing dramatically, and we're experiencing, the effects of it on a day by day basis. And this is not something that is like a nice to have. Oh, this may be good if we do this. This is a global imperative. And that's what people, I think really need to start paying more and more attention to is how do we grow our food to feed ourselves in a way that's not going to, destroy, the resources that we need to basically survive.
Yeah. Couldn't agree more. Now, in that you mentioned, obviously the heat waves and droughts that we've been experiencing. Most places in the globe, China's experienced it. We've been lucky here in Western Canada, it's been a much milder summer than last year, but certainly Europe and Africa's been on our radar for a while. So the question comes back probably to Duncan is why Africa? Because we know that climate change will have a major impact in Africa.
What I think a couple of years ago, science was more tilting towards the expectation that climate change had more effect on the semi-temperate kind of bands, not around the equator, but a bit further north and south of the in temperate zones, and not as much in the further north and Arctic zones. But you actually see, like you're saying, Russ, is that it's now, I think, across the board. We see massive drought in China, big impact on Arctic spheres as well, and also even in very temperate zones like we here in Northern Europe, the UK, Netherlands, Germany, where you actually see the drought now coming through as well. And as we already saw in Southern Europe, which was particularly badly hit, Portugal, Spain, Italy, and also in a number of regions in the US. So I think it starts to become more and more like a generic kind of issue. Every region gets impacted in the same way. Of course, Africa is a large continent with a large population, which historically, if you go back 50 to 100 years, was able to sustain itself in terms of food, but has become more and more an importer of food due to different reasons, resources glut, but also lack of skills and lack of capital. But you see now that a lot of local institutional investors where we are dealing with are also increasingly interested to see the potential of agriculture in Africa, increasing size of local markets, but also by the applying of new techniques, technology, utilizing efficient water usage on farms in different regions. So all our farms are in fact irrigation, so controlled irrigation farms, and that's where we see a big opportunity. So there's an abundance of land. There's in many regions an abundance of water, and the energy by the abundance of sun. So Africa is a good place to grow produce, and it doesn't need to be a net importer of food whatsoever. It can actually, in many instances, be an exporter. And when we looking at different zones, if you look at Central and Southern Africa, there's a lot of potential. We see in Zambia, in places like Malawi, we're looking at a number of opportunities currently in Uganda and Kenya. But historically, we've also done quite a few things in Morocco and in Nigeria. So there's different areas where we feel the context is conducive to investments, and actually proper yields can be made. If you look at, for example, in Southern Europe, is also where we are exploring activities. We see, due to climate change, also new crops, the potential of growing new crops in those areas which previously weren't able to be grown there, just because of the change there. But also historically, the underinvestment that has taken place there, and pretty much a fragmented industry. You see quite a few players amalgamating farms and putting in investments into efficient water management on those farms, and actually utilizing the scarce resources that are there to greater effect. So in that sense, you also see in areas that are prone to climate change, also a potential for investment. And of course, we've coming from a South African experience where we had also a massive drought in the Western Cape area between 2016 and 2018, which we've seen there. A lot of parties started to invest more and more into addressing these type of challenges, and just making sure that your farm is adapted to more erratic weather patterns, sudden big amount of water, no water, heat waves, just the volatility as such. Because apart from the heating itself, the gradual global heating, is that it becomes more and more erratic. So the extremes are coming more and more. The extremes are not extremes, but are starting to be the norm.
Mm-hmm. Yeah, so it's as much adaptation as mitigation
Correct.
and being able to adapt for a year of drought as opposed to the previous year of too much rain. Yeah.
Yeah.
That's farming in a nutshell down through the ages, I think. Andy.
No, yeah, no. I just wanted to just one other point about you're talking about why Africa. What's so interesting about Africa? It has more than 50 countries, and obviously a wide ranges of climate, etc. And our experiences, farming in Africa. Basically, what we're starting to do is to, as Duncan was talking about our expertise across a variety of different climates there and a variety of different crops, and in terms of water management, etc., is that we're taking that expertise and we're exporting that globally, in a way that will help protect our planet and to feed our planet. And that is kind of counter to the narrative that that some people might have of Africa. It's always aid dependent, and it's always people having to come to Africa's rescue, where we're actually what we're talking about is actually the reverse. We're talking about is exporting these regenerative agricultural principles that will help feed our planet in a way that does not destroy our most precious resource, which is our soil. So there is tremendous institutional knowledge that's been gleaned across a variety of different farming operations across the continent of Africa, which I think will play an important role in terms of trying to address, climate change and feeding our planet.
Yeah, I think one of the interesting points there is that you made the comment there's 50 countries, 50 plus countries in Africa, and I think especially from the West and maybe even more so in North America, we look at Africa and people say Africa and almost as if it's just one country, not realizing that it is the second largest continent on the planet and is diverse both in terms of climate, terrain, cultures, people. So I think we have a lot of catch up and learning to do, certainly from the West on what Africa is and how it functions and what the opportunities are. But with opportunities come risks, both business, political. We've touched on climate. That's the other, I guess, the other part of it that people will look at. Yes, there's opportunity, but what are the risks? Because we're always trying to balance off risk and reward as asset managers.
Our approach has always been that you need to ensure that your operations in a country are welcomed, in terms of that you're actually doing something which has a wider benefit, not only for us as the investors, but also in a wider context of stakeholders. So which is local communities, off-taker suppliers around you, integrating smallholders around your farming, utilize the infrastructure that we build, and providing them with access to markets because of our scale of the things we do. And once you ensure that and you keep on engaging with your wider context, if we go from a regenerative context, that you're not farming in isolation, you're farming in conjunction with your environment around you, physical, but also social. The people need to make sure that you're actually not extracting from the country and just utilizing the financial proceeds and taking them home. If that is a basic principle of what you do, and that's what we also do with local institutional capital, which we bring in, that gives, by definition, a financial flow to local co-investors, pension funds, and what have you, sovereign wealth funds when we deal with. So in that sense, you embed yourself into the investment, and I think once you've done that, you actually have taken away a big component of real and imagined political risks. In our experience over the 15 years, we've never actually had to deal with any kind of political fallout as such. Risk are, of course, as we already discussed, climate change, and that is something that you need to start capitalizing more into your capex programs to ensure that you actually can weather a drought. And maybe in the past you actually had to ensure that you could weather a 2-year drought. Going forward, you actually maybe increase the size of your dam and or your water reservoirs to weather 3 years, or maybe even more, 4 years. You need to be forward looking at it and making sure that your traditional rain-fed kind of operations are becoming more and more risky. So you need to ensure that you're more resilient, and actually even at the onset might overcapitalize your business in order to be able to weather those storms, or have overspec drainage that you actually, when you've got large downpours and water issues, that you actually have the capacity to drain your farm quicker by overspecking the infrastructure and the physical, the civil works on your farm. So and that costs money. So you need to invest more in that sense.
I would say that as Duncan was alluding to, the climatic risks are much more prevalent and much more impactful than the actual political risks. But another way that we potentially manage any potential political risk issues is sometimes we partner with what are called the multilateral development banks, like, for example, like the African Development Bank. And the African Development Bank is comprised of almost all the sovereign African nations, across the continent. And so that is, a way for us to, mitigate any perceived and or actual, political risk elements that could potentially arise.
Duncan, you alluded to it when we're talking about risks. Any operation that has any sort of scale has a social impact on the local community. It's almost agribiz versus traditional family-owned farms and small holdings. Is there a danger of displacing smallholders or turning them into sharecroppers or tenant farmers, or how do you work around that? Because to the small community, that's a huge risk or perceived risk.
Yeah, no, true. Luckily, the areas in Africa are so big that we've never had any kind of investments or farm proposition led to us for where we need to relocate people, because that's inherently complex and undesirable in any case, in my perspective. So there's a lot of farms that have become derelict or not utilized anymore, which have been utilized as commercial farms for a long time, but just have been abandoned because of different reasons. There's a lot of those opportunities around where you revitalize existing assets. For example, one of our investments in Malawi used to be an old tobacco farm, which was the traditional crop in Malawi. But given the global movement, of course, that produce is actually diminishing, and that's also something which we wouldn't be investing in any case. But the conversion of such a farm into what we've done there into new macadamia nut producer Agri is a good opportunity in that sense. So there's actually no need, and that in the context also, for example, in a Nigerian operation, where there's a cereal processing facility where you can actually utilize all the people that live and work around you and have their own farms to tap into the know-how of the large commercial hub, as well as having access to the market by supplying our mill and producing for the local market there. That provides actually the opportunity, and that's what I meant to cement yourselves as a desired partner into a wider context in a village and or town, by utilizing local suppliers and local people to work on your farm, and also as a supplier as well, as I said.
Yeah.
And Russ, I would just say, one other point about this. When we're talking about regenerative agriculture, it's not about just regenerating the soil, but about regenerating communities as well. And that's really, our strong belief is that we could have a win-win-win in terms about growing the crops in the right way, protecting our soil, and also enhancing the communities that we work in as well. So, I mean, I think when you talk about regenerative agriculture, it as Duncan said previously, it encapsulates a wide variety of things that are very, very important to us.
Yeah. So I mean, really, it falls in when I look at the classifications or buckets of various investments. I mean, growth and value are the two main buckets. But what this really falls under impact in investing, and from that concept, from that perspective, for those people that are interested in actually making an impact, this style of or this product or asset class, if you will, absolutely, I think falls under that category. Farming does have its downsides as far as the carbon footprint goes. There are inputs that release carbon back into the atmosphere. How do you continue to manage that carbon footprint on the operations? And I know that it will change depending on crops and things like that.
So it's the carbon sequestration potential of agriculture is very big, in fact, and in many instances it's still a net emitter historically if you're a mainstream farmer. But if you go to low or zero till farming, actually it also diminishes the amount of actual tractors on your land and the tilling itself, which actually consumes energy. But also your farming practice where you utilize and reintroduce the biological, the leaves and trees, which are, and put them back into the soil like the green manure, you're actually enhancing the value and the water capacity of your soil, and also the physical growth of plantations and of trees and what have you also have a carbon sequestration potential, because the tree and the root system actually sequestrates carbon as well. So it really depends on your farming practices, and the more you can implement and the more you transition towards that, the more capacity your farm has to actually offset and sequestrate carbon. There's a lot of research being done at the moment, but the communist opinion more or less is that if in case we would have utilized regenerative principles on every farm across the globe, that would sequestrate all the carbon being emitted in a given year per year. So you actually offset your total emitted. That is still under debate, and a lot of scientists are looking at that, but the potential is there. The potential for agriculture, as it is with forestry. Forestry is a much more established kind of business case for carbon sequestration, but agriculture, in a way, while applying the right methodology and farming practices, has a massive potential in this case.
We're using an algae-based fertilizer that retains water longer, and obviously, and then will help enhance the yield of our farms, in a way that's protective of the soil. Will allow us to basically try to enhance and prove out our kind of regenerative agricultural techniques. So there are ways, and obviously we're very committed to this, is to actually being carbon negative or carbon neutral in our farming practices and techniques. And this is obviously a very interesting space when especially a lot of large corporations are very interested in carbon credits and purchasing those, establishing the standards and principles around that area to help us deal with this very important issue.
One last question from me, which is probably primary to a lot of or to some people listening to this is the profitability of farming. When I started farming back in the 70s, it was a pretty hard scrabble business, and there was a lot of farms going under at the time. I know things have changed. Financing's gotten cheaper for farmers. The business has changed fundamentally, but with no promises to anybody because weather patterns change, things change, commodity prices change. What's the return on invested capital that you would look at from an average farm?
So just to start off, whichever farmer you talk to on the planet will always talk business, difficult. It's hard.
Yeah.
It's in the DNA. If you're a good farmer, you're complaining. There's always something to complain about. That's how it should be. So in that sense, it's sometimes also a bit distractive in a way that also very successful farmers, if you talk to, who's your banker? Say, I don't have a banker. I don't like the bank. So they own this massive asset, often ungeared, and which is a massive source of wealth. And that's what you see when you go to certain farmers here in the north in the Netherlands, or you go to the US or South Africa, you find them everywhere. So those are the successful ones. So it's a matter of scale. Scale is a factor in profitability. So it's capital intensive business. So you need to have the capital, and that's what we do because we're in the business of applying capital in larger scale commercial type farming. So in that sense, you are in an industry that can definitely make money. And going forward, which you see also we're entering an era of shortage, which definitely will go to food, and that's what we're already seeing currently. So the balance of power where in the past used to have been maybe in processing and the final off-taker is actually shifting back to the producer on the farm. So that's, I think, a macro trend which we'll see, which we already see happening as we speak. So being a capital intensive hard asset, so it has a very much a value retaining characteristic. So volatility, in fact, if you look at traditional kind of terms of investment, it's a low vol asset because it retains its value. It has a gradual growth of value, which is normally anything between CPI plus 1 to 4 or 5% in capital gain because of the scarce nature of the physical assets. So that's your underlying macro trend. And then over and above, you've got a direct yield, which is in developed markets a bit lower, between 3 to maybe 3.5%, 4%, while you see in more emerging areas, Eastern Europe, as well as Africa, direct yields of 8, 9, 10%. So you end up with a very decent ungeared return of low double digits, 12, 13% target, while in more developed countries, you're actually in the mid single digit type of returns historically, and that's a premium you get into more frontier type areas, or where you engage in a amalgamation of assets in developing countries, like developed markets in Southern Europe, which is a bit more hands-on and entails more managerial kind of input in order to create the scale and to link them into the global markets. So I think that's kind of the benchmark. So African assets, low to mid double digit, developed markets, mid to higher single digit.
Great, thanks. Any final thoughts?
I mentioned before, it's about ensuring that our most precious resources are alive and kicking, meaning like our soil and water, and ensuring that we're doing everything that we can to maximize both the benefit of our soil and water, and also ensuring that they will continue to be around to meet the needs of our planet for decades and generations to come. So this is an absolutely crucial area that people should really pay a lot of attention to, because you could really make a very impactful quote unquote return. And when I talk about return, I'm talking about really, ensuring that our planet is there for us and for our kids, our grandkids, our great grandkids, and doing a way that folks can really feel like they're really making a difference, because you can really make a difference. And on both, as Duncan and I were talking about previously, on both the asset level and also on the community level as well, because both of those are equally important.
Yeah, I think we touched upon it earlier on, and then also in the potential of agriculture and what we've been doing in reforestation around our farms, where you actually avoid erosion, also your water table management, and also the effect of enhanced pollination of, again, embedding your farm in a wider ecological zone. Is a massive opportunity, and by planting trees, you're actually enhancing the carbon sequestration potential of the whole farming enterprise as a whole. So that those things go hand in hand and enhances the value of your farm, because, again, maybe the concluding remark is that we're not working on maximizing yields in the next 2 to 3 years. It's optimizing yields on a decade by decade basis, and that's ties into the nature of family offices, which have an intergenerational kind of purpose as well. I would think that these type of assets, wherever they are, deserve some kind of place in such a portfolio.
I have a very close friend that has farming interests in the UK, and at that time, it was the insurance companies that were buying farmland because they looked at it as a long duration asset that would have cash flows, and of course, it's asset liability matching for them, and fit well into those long term. And I would imagine pension funds as well. Same thing. Asset liability matching, give us something that's got long duration with not entirely predictable, but decent cash flow returns and long-term appreciation.
Right.
Well, I'd like to thank both of you for joining us today. It's been a fascinating conversation. Really looking forward to see how your fund rolls out, and wishing you all the success. And thanks very much. Really enjoyed it. Okay.
Thanks so much, Russ.
Okay. Thanks, guys.